Hello, people. I apologize for being a couple minutes late. Uh, I have this really busy day job that has so many moving parts to it, and so unfortunately, that's what kept me from being on time. But I love that you guys are super patient and awesome. I see lots of chatter in the chat, so thank you guys. I appreciate it. Um, Couple funny story here. So Ryan, I swear to God, Ryan will be here. Um, we had some sort of miscommunication on where to be. He thought I was streaming. I thought he was coming to like be here in person. We obviously know how tech challenged I am, and there was no way we are gonna figure out how to stream in 5 minutes. So hopefully he'll be here in a live soon. So we do miss him, but you guys should check out his channel. It's called Escape to Arizona. For those of you who are new, my name's Lizy Hofer. I'm a loan officer in Phoenix, Arizona. I do weekly lives to answer all of your questions on buying process, on the market. To jump in on what's happening to the market, it's been an interesting roller coaster. So obviously the markets closed Monday because of Martin Luther King Day. And then yesterday it was like, I literally woke up to see that we had lost like 22 basis points. And I was like, okay, that's what kind of day it's going to be. It was not a great interest rate day. We saw some rebounds today. And it's just going to keep being like that. So very, very volatile, guys. If you're in the market to shop, I will tell you that it is super important to shop even within the same hour, because I promise you sometimes it's like the rate that I quote at 9 a.m. is different than the rate I quote at 3 p.m. And unfortunately, this is just the volatile market that we're going to be living in. There was some positive news, especially as it relates to new construction. So new housing starts, which is the number of new houses that they start constructions, were up by 1.4% in December. Housing permits are up by 9%. Completion rate is now up. And so what we're seeing is that new home construction is starting to move again. We saw some declines towards the end of last year that were not surprising, especially because we had major builders like D.R. Horton, giving information that they were going to slow production and slow contracts just because of supply and demand. And well, excuse me, not because of supply and demand. There's a lot of demand, but mainly because of supply chain due to labor, lumber, etc. So that was positive. To be expected, mortgage applications have fallen. Refinances are declining, and that will just happen more and more as we see interest rates rise. Now, I've seen a ton of questions regarding, where interest rates are going to be. I did a couple of presentations, and I actually was really surprised to see people thinking that interest rates might be as high as 6 to 7%. I do want to just clarify my thought process on this. And obviously, I'm not a psychic and I have no pull with the Fed or what really happens with mortgage-backed securities. I just kind of give you my opinion. But every time interest rates increase 1%, it drops a buyer's home purchasing power about 10%. And so let's say you're buying a $400,000 house. If you want expected the same monthly payment, you're looking at a $360,000 house now. And so if interest rates were to rise that high, it would really dramatically impact affordability and home values. And I just don't see the people that are in charge of our economy, like the Fed. I don't think that they would do something like that. I think that FHFA is very responsive to the needs of first-time homebuyers and the needs of occupant homebuyers. And I really think affordability is on their radar. Reasons that I think that, well, the big change that just rolled out, I talked about this last week, but just to bring it up again, but there's a huge price increase in terms of loan level price adjustments to second homes that will be going into effect for some lenders as soon as February. It's for loans that are being purchased and serviced on the back end in April. But essentially, it's making second homes just as expensive as investment properties. And this should discourage some people from buying a second home. What they're trying to do is just control the amount of people that are buying Airbnbs or that are buying properties not to occupy, so that more people like you guys can enter into the market. And so, yeah, so that's just like my 50 cents on what I think will happen with rates. I'm not worried about them going up into the 6 and 7% level. We did see something very similar last year around this time. We saw interest rates creep into the fours. And so my expectation is going to be in the fours, maybe low fives, where things are still reasonably affordable for people. So anyway, I hope that helps you guys with your home shopping. I know it is beyond stressful. Like, as a loan officer, it is very, very stressful. And so I feel your pain. And so I hope you guys get the best interest rates. Alrighty, so who do we have on this live chat? So we got Jesus with really hilarious knock-knock jokes. I hope Javier makes his appearance known. We have Bao Julie, first-time homebuyer from Wisconsin. Well, thank you for coming. I think this is the first time I've seen anyone from there. So yay. We have Jen tuning in from Scottsdale. We love Jen. Jen works on my team. She's amazing and she helps me with all these lives. We have Rod and Laura. Good to see you guys. Yep, rates are very aggressively going up. We have Green Energy Rules. Looking forward to the market update. Well, let me know how I did. And then we have Mario Flores with our first question. And it says, what's the best way to prepare to buy a second home to use as a primary and rent out my first home? So my best recommendation for this is, one, again, start with your budget and make sure that you have enough money prepared and set aside, one, for a down payment, because you'll need a new down payment, closing costs, and then you'll want to save reserve payments for mortgage payments at least 2 to 6 months on each house, and then you'll want to save at least 10 to 25% of whatever that mortgage payment is a month for maintenance items that'll happen down the road. So that's what I recommend as your next step, especially if you're going to become a landlord. This is how I bought a lot of my real estate. It was like I call it the move up buy, right? The move up house hack. It's an awesome way to buy another property with minimal down, get the best interest rates, and then maximize your cash flow. One thing you will want to pay attention to is that if you have plans of ever selling these properties, there are capital gains tax law that you guys should learn about. If you've occupied a residence for 2 years, generally, and selling within the most recent 5 years, you can pay lesser taxes. I mean, at least right now. So something to look into. Again, not a tax professional, but it's what I used when we were buying our homes. All right, so hopefully that helps, Mario. We have Scott. Hello, Scott. Scott says, if I have plenty of cash for down payment, can I buy more than one investment property at the same time? And the answer to that is yes. Now, sometimes it's complicated when you're buying properties simultaneously. You always have to account for a lot of people use the future rents of the property to help them qualify and offset the future mortgage payment. If that is something that you're needing to do because of debt to income ratio, if that's something that you have to do due to debt to income ratio, the biggest thing is that buying simultaneously might disqualify you because one of the homes will have to be hit the full payment in your debts. So I always recommend maybe doing one and then purchasing another one. But if debt to income ratio is not your issue and reserves not your issue, then I would say go for it. You can absolutely do it. Let's see. So Yomar says, with interest rates fluctuating so much right now, you have to run into individuals not being able to purchase a home, meaning due to the rates. Yep. So basically what Yomar is talking about is the affordability issue that we have. And unfortunately, some home buyers are going to be disqualified from the marketplace. And it sucks. But there are areas in the country where you can move and homes are still very affordable. Is everything okay? Sorry. There's a lot of noise in the background, so Zeke's going to check it out. Okay. So yes, so a lot of people are going to be priced out of the market, unfortunately, but there are still so many home buyers that are interested, and I don't think that their inability to purchase is actually going to impact housing. And so it is something to pay attention to. If you are somebody who falls into this category, again, like I said, dig deep into your budget and figure out ways for you either to make more income, to minimize debts. All right. So Gabby D says, why wouldn't a lender have 3% down for conventional? I have great credit. I'm a first-time home buyer and low debt to income ratio. Um, Honestly, that's a really weird scenario. Most lenders do have a 3% down conventional for first-time home buyers. So I would say maybe just shop your home loan around. So fun story. I can't see myself in the chat, by the way, on the computer. I don't know if this is up to date, but I just wanted to acknowledge that, and it's also very distracting. Okay, guys, I'm going to go to some questions here while I try to kind of troubleshoot that situation. So Xavier says, is it a good time to refinance before rates go even higher? How fast are rates rising? Well, since the beginning of the year, guys, most lenders are pricing anywhere between 0.5 to 0.25% higher in interest rates. So, I mean, that's how fast they're rising. I think that if you were quoted a rate in the 2%, it's likely that that rate is 0.5% or, thank you, you're the best, 0.5% or at least 1% over that. So rates are moving up quickly. If your plan was to, lower your monthly payment, now is probably the best time more than ever. And then Adam says, why are interest rates going up so quickly? The Fed hasn't even increased the Fed funds rate yet. And so, again, those concepts get confused quite often. So the Fed controls the rate at which banks borrow money from the government. And so even though they're not directly correlated, so like when the Fed bumps up interest rates, it doesn't impact mortgages. What it does is it creates this stress within the economy. So like when they do that, typically the stock market rises, and when the stock market rises, people pull their money out of stocks and take their money out of bonds and mortgage-backed securities, and they place them into stocks, and that's what drives interest rates up. It's coincidental that that happens, and sometimes it doesn't happen. Sometimes they raise the Fed funds rate and interest rates have a great day. And so you never want to bank on that. What's happening right now is that there's very minimal economic fear, and bonds and mortgage-backed securities are the vehicle for fear, right? When you're worried that you don't know it's too volatile in the stock market and you want a sure thing, a sure return, that's where you put your money. When all things seem great in the stock market and other investments, that's where people go. And so that's what we're seeing right now. Just so you guys know, the Fed was buying mortgage-backed securities to keep interest rates artificially low. The demand was never there to be in the 2%. And so a lot of people don't really understand that. And unfortunately, there's so much ridiculous marketing out there with interest rates that are still like super low. Like I saw somebody was like, I thought interest rates were 2.25. And it's like, well, you got that mailer like more than 30 days ago, and it's so important that you check current interest rates. And oh, by the way, that's a mailer. It's an advertisement that gets you to call because the rate is so low. Most of the mail that you guys get for advertisements for interest rates, most of the shit you see on the internet, most of it's out of compliance, just so you guys know, and most of it's illegal. So there's that too. All right. So let's see. We have Doug Schemmel from Maryland, good to see you. We have Abraham Ariza, good to see you too. He says, if thinking of purchasing a second home after the pricing adjustments, what kind of increase in interest rates do you anticipate? Well, interest rates for an investment property, depending on how much you put down and what your credit score are, I mean, they're somewhere in the ballpark between like 0.5%, sometimes a full percent higher than where they are in primary interest or primary residences. So I'm going to say that that's where I think that they're going to land. I never recommend like panic buying anything. And I know that there's a lot of people right now trying to capitalize on a second home purchase right now because they don't want to miss out on low interest rates. But you never want to buy something if your budget doesn't say it's ready, if you don't have the right proper reserves, you'll only regret it. So you do want to pay attention to that now is the right time for you budget-wise. So Yomar says, is having no debt a bad thing when applying for a home loan? Yeah, I mean, in all fairness, it depends on if you have no credit, right? That's actually difficult when you're trying to apply for a home loan. FHA loans allow for no credit borrowers or alternative credit borrowers, and there are some conventional financing that also allow for manual underwrites that way. But generally speaking, you get higher interest rates, higher mortgage insurance when you're purchasing in that way. And that I do see to be challenges for some buyers. Now, as far as not having any credit being spent on a credit card or having like no installment debt, and I mean, I see lots of people in that circumstance with super high FICO scores, and it doesn't impact their ability to qualify at all. It's just whether or not you have active reporting credit and you have a credit score that matters more than the amount of debt you have. So Nicola says, I just want to thank you again for your realtor recommendation. We're still in contact weekly and are talking deals over in the Sacramento market. I only wish I could have you do my loans. I know. I thank you for saying that. And one of these days I might just decide to get licensed nationally. It's not today though. Today I'm reconsidering my day job. But I appreciate that. And I love that you are finally able to get like closer to getting that investment property. Alrighty, I don't know what's up with my stutter. I'm like overwhelmed. I'm overwhelmed and need to chill for like 2 seconds. I know. All right. So Green Energy Rule says when people buy a home in a neighborhood and turn it into a rehab or retirement home, is that the same loan for residential? Do they buy it as a residential and then change it? So lots of answers to that. So I actually had a debate with an underwriter today regarding group homes. So group homes are allowed on conventional financing because they're residential properties intended for disabled people to live together with assistance. And for that reason, because the integrity of the property is still mainly residential, they are allowed for conventional financing. There are a lot of retirement centers or like businesses that are operated that the structural integrity of the internal side of the property is more commercial than residential. And in that case, I do see people either financing with a commercial loan or they bought it as a residential investment property and then converted it later. There aren't, to my knowledge, any residential loans that will build you like a commercial retirement facility and still have it be conventional financing. So we have Will Salazar says, hi, Lizzie. I refinanced with your team last year to get out of PMI and secure a lower interest rate. How long until I can cash out refinance to help with debt and renovations? So whenever you're doing a cash out refinance, you have to have made 6 payments. So that's generally after 7 months. And then you're eligible to do it again. So I hope that helps. And thank you so much for using my team. I know that I think you just entered into real estate. If this is who I'm thinking, go ahead and confirm. If you have any real estate questions, he might be able to help you answer them. All right. So let's see. So Mike says, why do you have to run credit 2 times if we go with 2 lenders? So I think what he's implying in this question is, why does he have to have his credit run again if he's shopping lenders? And the reason for that is because, well, a lender is going to want to guarantee, if they are quoting you rates and payments, what all the terms are of the rates and payments that they're quoting you. And a big factor to most interest rates at most, like I think all companies, is your credit score. And so that's why the Fair Credit Reporting Act allows for you to be able to have, you know, multiple pulls for the same thing within a certain time period and have it not impact your credit score. They understand that what's right for the consumer is to be able to shop. And so I wouldn't have this fear as much as it's like an urban legend, the same way that like putting 20% on your home purchase is the only way to be able to buy. So, all right. Okay, perfect. Nicola says, you are welcome. Already have a first property. Now hungry for more. Good job. And then Will Salazar is a new agent, guys, in Phoenix. If you're looking for real estate, he's obviously my past client, so I'm very biased. But honestly, he's super hardworking, very entrepreneurial, and I know he's going to do a phenomenal job. All right. So Mary says, can we approach multiple realtors to help us find a property? We want to get the best deal. So this is not a great question for a loan officer because I don't know 100% what all the realtor rules are, but I do know that a lot of first-time home buyers sign these agreements called a buyer-broker agreement, which commit you to working with one agent for an extended period of time. And the benefit is that I know that there's like a lot of misconceptions on, the fact that realtors make 3 to 6%, and some of them are lazy and some of them don't work hard, or you're doing all the work to find properties. I mean, I hear these things all the time, but real estate agents are not all made the same, and their job is really difficult. They're like your financial fiduciary between you and the seller, and they're your legal representation on this. So you definitely don't want to skim. The right realtor can save you a ton of money, save you a ton of headache, and I don't think it's professional to engage multiple people who will go to work for you for free. They only get paid when they close your transaction, and sometimes like they're showing you literally dozens and dozens of homes, especially in this market. So I know that it's frustrating when you can't find the right property, but no, in my opinion, I don't think it's the right move to engage multiple realtors to help you with that. Let me know in the comments if you actually agree with that or not. All right. So Devin says, hearing anything about 40-year mortgages, lower payments, at what cost? So I've actually heard quite a bit of information about 40-year mortgages for months now, that this was something that they were going to roll out. It's been on a bunch of like insider blogs, but I haven't seen any announcements from FHFA. I think what they're doing is, as they're seeing interest rates rise, they're going to come up with more and more solutions for first-time and occupant buyers. Last year, one of the big pushes was actually in manufactured housing, and so there are like now is 3% down for newer manufactured homes that meet Fannie Mae criteria, and that was their big move towards helping with the affordability issue, because a lot of times what happens to markets like this is that first-time home buyers end up being pushed towards alternative properties like manufactured homes, townhomes, condos versus single family residences. And just so you know, I don't think there's anything wrong with that. My first home was a condo. And I think that there's a lot of benefits if you're a first time home buyer to having less maintenance responsibilities. So anyway, I digress. But nothing official yet, and I will definitely keep you guys updated. Now, extending your mortgage term is pretty controversial when it comes to mortgages, I guess, mainly because the amount of interest that you pay over time. It's like over 30 years, you're basically paying double what the purchase price is, right? If you factor in all the interest, if you made only the minimum payments. And so again, adding another 10 years is going to tack on to the debt. But I will say in most cases, owning a home is, especially in this market, is oftentimes more affordable than rent. And it's the only thing that you will have to pay regardless, unless you're able to live at home, right? That you can replace, and that grows in equity, whatever the cost is. Like a lot of times people will own their home for 20 years and walk away with literally the exact amount that they bought their home in equity. And even though you're paying interest, right? There's nothing else. Like you're not going to do that with rent. So that's my argument for that. All right. Araceli says, do I know anything about ITIN loans? So I do know very minimal about ITIN loans. I get lots of advertisements for them, but I have yet to meet a lender that can actually finance them. It's kind of nuts. I think they're hard money lenders that do them. I think NACA claims to help ITIN buyers, but I've never known of anyone who is reputable that lends on them. Sorry about that. So Energy says, such a crazy cost. We need 60 years to keep up with this market. Yeah, you guys, it is really nuts. Home values have really been driven up, especially because of the low interest rates. That was not really helping with demand, but we were already headed in that direction. And unfortunately, they're going to have to figure out other vehicles. So in the past, things that have been done to help with like lower monthly payments were ARMs, right? So, get this low fixed interest rate for a certain amount of time, and then your rest of your payments would be at this interest rate. So that was a vehicle. The other thing was negative amortization loans, which had like a teaser rate, and then whatever you didn't pay down would actually get tacked on to the end of your mortgage, which is awful because that's like compound interest. It's like the worst situation you can be in for a home loan. Interest only was something that happened due to affordability. And so because the recession was so traumatic, and all of those loans have such like bad connotations to them, like bad associations, I don't know how many of them will resurface. I think ARMs might make a comeback. There was this thing called a 2-1 buy down I mean, that still exists, but I haven't seen people really promoting it where you pay a premium upfront to get your interest rate bought down like 1% or 1.5%. So, I mean, I think we're going to see that stuff coupled with longer terms. I think longer terms is generally kind of where people are leaning just because it's probably less risky than, having people pay on a shorter term. So I don't know. I don't know what where we go from here, but I don't know that we're going to see anything that's really going to bring the value of homes down. And I know lots of people advocate for that, but that's at the expense of so many people's finances and so many people's retirements. And so we really wouldn't want that to happen just in general. With so many positions going fully remote and big city prices increasing rapidly, do you see a shift of buyers looking in more rural areas and communities? Yep, absolutely, guys. So that was something that made national headlines last year. What's tricky about that is that I do think that there is going to be a resurgence of people coming back in to work in business buildings. I think that what was interesting is that we realized that we can all work from home. So that was a big aha moment for people, me especially. Like now I've been more willing to hire people from around the country where I was, really restricted to a talent pool here in Phoenix. And so that was really eye-opening. But as somebody who runs a team, who's very entrepreneurial, I mean, we're missing a spark. And so in general, I think productivity over the long haul, I don't know if we have enough data to keep people at home. And so right now it's happening quite a bit. We're seeing people be able to purchase, but I don't know if it's long term or not. So just keep that in mind if you are somebody else who works remotely. Is this a permanently remote position and not just temporary? All right. So that was so interesting. Can you please do a history of loans video? Okay, so I need more elaboration. Like what specifically on the history of loans? Like the history of all the different types of loans, like history of interest rates, history of documents. I mean, like what kind of history? I think I was talking about like the different types of loans, right? Okay. Yeah, I mean that might have been the video though. Okay, my phone is going bananas. I always like worry if like something is happening on the live stream that I've done crazily, right? Um, okay, perfect. Okay, all right. So Millennial Money. Oh, I'm bummed he missed this one too. It says, I missed your live last week. I'm wondering what your thoughts are on buying new construction right now when rates are supposed to go up by March, and my home won't be complete until spring of 23. I'm worried about being in contract while prices are high. I don't know where rates will be next year. So this is one of the negative side effects of buying new construction. So a lot of people like them because they're new. They're having so much trouble buying a resale home, and so they're going to new construction. And so here's what I will tell you, like one of the best strategies is to budget for a point or a half a point above where your interest rates currently are. Now, I'm not saying that that's where interest rates will be, but it does hedge your bet. And if you're comfortable with what that payment is, you'll be okay. And if not, then what items can you reduce in your budget? Because those are the things that you know, have an impact on, or is there an ability for you to be able to make more money? I find that this strategy of making more money is actually more doable than you think. Another success story, I literally talked to this gal in December. She wanted to buy at a higher price point. I gave her some figures for what she would need to earn. Her current employer said no, but she was actually able to find another position at a competing firm for literally more than what we had negotiated. And now she's like within 30 days, well on her way to buy a house in a higher price point. So just another thing, like if that is a struggle for you, something that you can do. I fully anticipate that interest rates will be higher next year, but one benefit of buying new construction is that you get the added value day one of all the equity, all the appreciation that your property would have incurred over a year, right, without you living there. So day one, a lot of people on new construction are walking in with so much equity. So it is one of those rate of return. You're just going to have to really look at like, okay, my payment's going up X. the value of the house is going to be X number of dollars higher. Here's what I'm going to exclude for my budget. And hopefully that all pencils out for you. Okay. All right. So let's see. So Solomon says, I'm getting closer to relocating and buying a new home. Is it necessary for the lender to need a letter that I can work remotely from home? Yes. And this is like one of those things, guys. I was kind of alluding to this previously. I have a lot of clients who can temporarily work from home due to COVID, who are trying to buy homes and then are like nervous about telling their employers that they're planning on moving states. You cannot hide those things from your lender. We require it because if your employment is contingent on your location, you cannot occupy the property. And there's so many things, so many loan problems ensue from just that issue. Okay, perfect. Oh, well, good. I'm glad that I helped you guys see some new things on the history of loans and then also about new construction. And thank you, Franco. I'm glad that I showed up with both eyebrows during this live chat today. I will take that compliment. Alrighty. So Tim says, is there another crash/correction that I think would affect the suburbs more than other places? Yeah, so guys, just so you know, whenever you're buying in an outskirted area, those are typically the most at-risk areas for valuation fluctuations. And so in the near future, I'm not saying anything that is going to bring a massive correction, even interest rates. Okay. I think I talked about this last week, and if not last week, I've definitely brought it up on this live. But right now we have a mathematical issue when it comes to the number of people that need homes to live in and the pace at which new homes are being constructed. Okay, so it is just a math problem. And so if you have 10 people who want to buy one house, you still have 9 people more than the one house. If you have 5 people, because demand dropped by 50%, who want to buy the one house, you still have 4 people that don't have a house. Even if it goes down by another 50%, guys, there's only one house and 2 people. And so that has to shift so that there's like 2 houses for every 1 person before values really switch. And there's a lot of people talking about the crash, a lot of people talking about this shadow inventory of foreclosures and short sales, and it just never came because there was nothing like economically that we could show that would create the kind of conditions to have people foreclose. The reason that they did a forbearance was to make sure that that wouldn't happen, and I think it was very, very successful. So aside from massive foreclosures and population growth changes or a change in actual inventory, nothing that I see in like within the next like 3 years. Okay, so let's see here. Oh, Crypto Fox, thank you. That means so much to me. I'm so glad that you love the cupcakes. Let's says Hector says, how would using a 401k for a down payment work, and could it be combined with cash? So using a 401k, it all depends on what your withdrawal terms say. So every company will have their own set of restrictions for how much money that they can actually withdraw, because generally retirement funds are pooled in a larger investment. And so many cases you're allowed to borrow 50 to 60% of whatever the vested value is. So that means like anything that you can withdraw. Occasionally you get like matches or you get additional money from your employer that has to be in the account for a certain length of time before it's considered vested. And so generally speaking, you can borrow in terms of a loan or you can withdraw. And if you're withdrawing for a real estate purchase, my understanding, and again, I'm not a tax professional, is that the tax penalty for that is actually less. So some cases you can only withdraw in case of a first-time home purchase or in case of a financial hardship. So that's a hardship withdrawal, but you'll have to check with your 401k terms just to know for sure. I've seen some 401ks that do not allow for withdrawals or loans, so it isn't always a guarantee. And I've also seen some that have very, very low withdrawal amounts or very low like loan amounts too. So again, you will want to check. And yes, it can absolutely be combined with cash, can be combined with a gift. It just can't be combined with like, borrowing from your credit card. So there is that. Okay, so Matthew Glindsey says, shout out to Lizy. I always try to catch your lives and drop um, live earlier. Oh, you dropped an earlier live? Oh, thank you so much for dropping someone else's live to come to mine. That means so much to me. Thank you. I feel like I finally caught my groove. I was like hyperventilating at one moment internally. So I'm so glad that you turned in for this one. Okay, so Aaron says, advice for someone with a wife and a new baby. I have about 300 saved, but mostly in stocks and a 401k. I would have to pay taxes if I withdraw from stocks to use for a down payment. My industry got rocked by COVID, so I'm uncertain about my job moving forward. Family keeps telling us to buy a home while I'm employed and have I'm looking at the $300,000 to $400,000 range, nothing too expensive, but my gut is telling me not to do it. Should I buy while I have a job and lock in a low mortgage, or sit back until COVID takes its course and I get more clarity on work market, etc.? This is a very loaded question, and obviously I'm going to tell you what I think makes the most sense, and then I also want to talk about like people's money mindsets, because typically people who are like, if you're gainfully employed, here's things that you have to look at. If you lost your job tomorrow, could you go into the same industry, and how hard would it be for you to find a job? If it wouldn't be fairly difficult for you to find a job, but this one is unstable, I would say let's look into it. Let's see what the budget looks like. If your income was reduced, like a couple dollars, what does that look like? If your industry is not hiring right now, or if you feel like the income might be reduced substantially, I don't think it's ever a good idea to make a long-term commitment. I really believe that you buy when your budget says it's ready, and you buy when you feel the most financially stable. Now, that being said, I do talk to lots of people who have a lot of money saved in retirement, a lot of money saved in the bank, and they're afraid to pull the trigger because they've been paying like $800 in rent, and they don't want to pay a $2,000 mortgage payment. And here's what I always tell people, again, is dig into that budget. I had a really wonderful young couple last month who was paying $1,500. The mortgage payment was going to be like $2,400, and their debt to income ratio was going to be under 20%. But because they had been like psychologically conditioned to only pay $1,500, they were too nervous to pull the trigger until they actually looked at their budget and realized how much disposable income they had to be able to like make that happen for themselves and not change any of their lifestyle. And so I'm super excited because they actually became home buyers fairly quickly, but it wasn't without that realization that yes, they have enough money in savings in case something bad happened. Yes, they have enough disposable income, and yes, it made sense with their budget. You might have a ton of assets and might be out of work for 6 months to a year. If that is you, no, I would not recommend getting into a commitment like that. Now, you might also be very fearful about your job, and then that's something else you have to look into. I can't tell you how many people have been sitting on the fence for many years, waiting for interest rates to go down or waiting for home values to go down, and they have just completely missed the boat. And they missed the boat on like double-digit appreciation. They're paying higher rent payments. They missed the 2% interest rates, and that fear of like making this commitment has cost them like, I don't know, at minimum like tens to $50,000s, $100,000. I mean, it's sad to me. All right, so let's see. So hey, I've had the same great tenants in my rental for 5 years, but I've kept their rent the same, about $2,000, with no increases. Costs with property are increasing. What's your recommendation for an increase? So I would see what houses are going for in the neighboring areas, and I would see how much you do need to raise the rent. I mean, unfortunately, you bought the property as an investment, and while it's great that you have kept their rent the same, like utility costs have gone up, maintenance costs have gone up. Property taxes have gone up, and so that you keeping the rent the same amount is actually eating into your profits, and it's not like win-win. It's like win at your expense. And so I would increase the rent incrementally, is typically what I would do. I would say, hey, for I mean, it depends on how far you're off, right? But I've seen a lot of landlords do this where like they're literally losing like $500 to $1,000 a month in rent. And so what I always say is, hey, for the next 6 months, we're going to increase the rent $200. After that 6 months, we're going to raise the rent another $200. If you're willing to sign an X number of lease, that'll be it, right? We'll split the difference. And then again, do the same incremental increases, but I wouldn't just keep it the same. It is an investment for you, and because you own an investment property right now, I mean, this is a type of market that is in your favor. It won't always be like that. Says, hi Lizy, is there a team that can help my wife and I prepare for buying a house? I'm looking for a guide on how to save, what my credit score needs to be, and what the down payment scenarios look like. Yeah, there's tons of teams that help with that. Mine specifically, if you're in Arizona, and we would love to help you with that scenario. Another thing that you can do is I have a budget guide online that walks you through like all the steps of analyzing your income and shows you what an appropriate amount is to hypothetically budget for housing. But I would definitely recommend getting with a mortgage advisor at minimum 6 months before you decide to take the plunge, just to work out the what if scenarios on your budget, closing costs, down payments, etc. Priya says, I very much hope like your videos and your insights. As a first-time home buyer, are there any rules on using 5 to 10% of money gifted 6 months or more towards down payments? So here's the thing about having your own funds. There are certain programs, like the 3% down program requires you to have your own funds on a conventional loan. But if you're doing 5 to 10% down, there is no limitation on how much that can be for a gift. It could be 100% a gift. Now, it might not always score, so you might not always receive an approved eligible. And I will say that having skin in the game does look more favorably in the automated systems when it comes to running your files through. But there is no technical rule that you'll need to know, aside from that the gift has to be from a family member and not just like your second cousin. It's like aunt, uncle, grandparents, step parents, something that can be documented. All right, so let's get a couple more questions in the live, guys. All right, so let's see. Okay. Mel says, I love your vids. Does it sound suspicious on a home that did not disclose on a solar lease? What's my take on it? So, we live in Arizona, and this happens quite frequently. And believe it or not, it's actually been happening to me in the process of refinancing people's homes. I literally had 2 refinances that a solar lease just popped up because they just bought solar in the process. This is the same as buying any debt, and it is considered a lien on your property, which means that it gets attached to the title. And unfortunately, because people don't really consider solar a debt, they more see it as a utility expense. A lot of times sellers unknowingly forget to mention it. It most always comes up, though. I've yet to have a situation where a house closes and we weren't aware of their solar, especially because most houses involve a physical inspection, so an appraisal. But I don't know if it's as malicious as it sounds in this question that I received. I think a lot of times it's just not thought of as a loan or a lien. All right. So it says, do I qualify for first-time homebuyer assistance or any assistance, 72 gross monthly income? Okay, family of 7. Here's the thing. I can only quote what I know in Arizona, and the income limit for Home in 5 and Home Plus, I think, is $112,000 and some change. And so yes, according to that, you would qualify for those programs, but there are other requirements like credit and debt to income ratio. And so you only asked me one specific thing. And I do know other municipalities have down payment restrictions, but typically you have to be 80% of the area median income, and then that increases per family member. So you will have to look up the specific guidelines for the housing program that you're looking for, but that was the information that I know for Arizona. So are you buying in Arizona? Hopefully that's a yes, so that applies to you. Okay, So Sam says, I work in healthcare staffing, earn a lot of money through commission, and the lender I talked to said I need at minimum 24-month commission history to use it for qualifying for a loan. Is there no other workaround for this? My wife stays at home with the kiddos, and I have one on the way. I make good income, but the commission only started a year ago, so I'm wondering if I have to wait another year so that I have a full 2-year history. So here's the thing with that is that generally the requirement is we want to see that you have a minimum of a 2-year history in that line of work and that the commission income is increasing and stable and likely to continue. So you can get away in some circumstances with having a 1-year requirement, but not all lenders abide by that rule. Some of them have overlays like it appears like the lender that you're speaking to, and some of them are also uneducated. Like truthfully, they haven't kept up with where guidelines are. I had a situation literally last month where I was called on, can somebody have 2 jobs at the same time for less than 2 years? My initial answer was, yep, they have to have 2 years uninterrupted. But I'm like, but let me double check. And it turns out that that guideline had also changed to show that so long as the income is increasing and stable and likely to continue, you might get away with 1 year. And so it really is dependent on the lender. If you get a no, guys, it is always a good idea to shop around. You never know what is just specific to that bank or not. All right. Oh, bummer. Okay, so you can't find any. If you send me an email, I might be able to help you find a loan officer in that area that is familiar with down payment assistance. They would know better, and I would love to be able to help you and your family get into a home. Alrighty, guys. So we're just approaching 7 p.m., and I have had one hell of a day. So I am going to call the live slightly early, but just because I'm really tired and hope you guys can understand. I appreciate you guys coming. Please check out the last video. It's all about how rising interest rates will impact your home buying. I give lots of really good scenarios on payments and things that you can do to combat this. As always, guys, I try to provide you with the most up-to-date information for your home searches, and I really hope that I'm providing you with the value that you need to get and be a successful homeowner. So I appreciate you. Thank you for coming to the live. Don't forget to thumbs up this live stream, and I will see you next week.